All right, today we're talking about real estate funds versus syndications, which is just a fancy way of saying one-off deals. And we're going to talk about this in detail because it might save you hundreds of thousands of dollars if you make the right choice for you and your portfolio. All right, so funds, what are we talking about? We're talking about a portfolio of investments, right? It's pretty simple, right? You have the fund up here, the mothership, and then you have the individual investments. We're going to focus on properties right here that you end up investing in. And each of these in a real estate context and also in private equity, which this framework works for private equity investments as well. Each of these investments would be its own LLC, right? And so the risk for that investment is encased in that LLC, that structure. You as the LP, the limited partner, you're making an investment, of course, into the fund, into the mothership that then invests in each of these investments. And so you're getting a diversification here. In this case, this would be 5 assets, so you're getting 20% exposure to each of those. And so, okay, so if this one goes kaput, that's a 20% loss, but these can hopefully more than make up for the one deal that got away, the one deal that didn't do very well. Versus a syndication, right? It's pretty simple. It's just a one-off deal, right? You're just investing in one LLC. You as the LP here, right? And so hopefully that thing better do real well. So here, because you're spreading out the capital, your range of outcomes is going to be a little bit tighter in terms of your returns, right? You're generally not going to get too many zeros because, once again, you have the ability to diversify. But it's really hard to get, 20+% returns because, once again, the bad ones could weigh down some of the good ones. Of course, with a single off syndication, the range of outcomes is really wide, right? You easily can have negative, right? You can lose 100%. And you can maybe 5x your return, right? Maybe you get closer to a 3x here over 10 years, whereas you can get 5x's over 10 years in a syndication, right? The range of outcomes is just much wider. All right, so that's the returns. Okay, now let's talk about the risk a little bit more. We've kind of talked about losing one asset here, but why does that happen? Well, lots of surprises can happen when you make an investment, and sometimes they're completely random. You could have a weather event, you could have a regulatory action, you could have the stroke of the pen from the government completely change the dynamics of an industry that wipe out this return. It wouldn't be the sponsor's fault, the general partner, right? So you're going to have to invest in more of these individually if you want to spread out your returns. Here, it's kind of packaged for you into one fund where you automatically get the diversification and therefore reduce the risk. All right, so next up, you have taxes. Here, it's a little bit complicated because what happens if all these investments are in multiple states? You're getting state tax returns for each one, and it takes a little bit longer sometimes for the tax returns to roll up into the fund where you get your 1K1, right? That's the tax form. Hopefully you get it in April, but most of the time in a fund, you'll get it closer to late summer. Whereas with a single one-off deal, oftentimes it's pretty simple, right? You got one asset, you get one simple state K1. Oftentimes you'll get this in March. All right, so it's a little more complicated from a tax standpoint to do a fund, which of course is what you have to give up for the lower risk. One of the things. All right, now we're going to talk about 4 here. This is capital, the mystery number. So in order to invest in a fund and get this diversification, plenty of retail investors only have to invest, say, $100,000. Whereas, what happens if you wanted to get diversification over here? Well, to replicate the same diversification, you would have to do 5 of these, right? Times 100. We obviously can do the math, right? We got $500,000 over here. And this is where I see most retail investors mess up, is that they think that they could put $100,000 into a real estate individual property syndication, and that is their entire real estate exposure. Maybe they have $1 million in total portfolio, and they say, I'm going to write this one check, this $100,000 into this one real estate deal. Well, that's a problem, right? Because once again, what happens this has a weather event. It's a poor performing deal. Lots of things can happen, and yet you've given your entire real estate allocation, right? Because the rest of your money is in stock and bonds, perhaps. Maybe you have another private equity investment, but your entire real estate allocation now is exposed to one deal, one sponsor. That's not a good situation, right? Whereas once again, we talked about how you can get that same 100K across multiple deals. So you often see investors do this where they should be allocating a lot more to get that diversification across 5 deals, but you got to make sure you have the capital to do that. Otherwise, you probably should be going into a fund. All right, and let's just recap the benefits here. We got funds. Generally, returns are a little bit lower, right? A little bit lower risk, so a little bit lower returns. Those things go together. So the range of outcomes, once again, is a little tight. The dispersion over here, way bigger, right? So your returns are a little bit higher. Your opportunity to get higher returns on average or higher here. Risks. All right, once again, funds gonna be lower risk, diversification, one-off deals higher. Taxes, this is going to be worse, better, just from a complexity standpoint. It's not that big of a deal, but if you're not used to extending your tax return and you invest in a bunch of funds, you're probably gonna wanna extend. And then lastly, capital here is lower, the needs for the capital, and higher over here. All right, so that's real estate funds versus syndications. If you're interested in learning more about how this might affect your actual portfolio, go ahead and click the link below. All right, thank you.